All right, well, we'll go ahead and get started. Thank you, everyone, for joining, and anyone who's watching the recording, thank you for joining as well. I'm Jordan Fry from the Prudent Plastic Surgeon. I am very excited to have Ross Curtis here with us tonight, who is president at BV Capital. Baylor alum, as we were just discussing, based on the flag in the back. And then I can attest to his fine judgment because he did name his son Jordan as well. So you can't beat that. But I'm super excited to have Ross here and talking about a really powerful tax strategy that a lot of times gets uh, either confused or even brought too much into the weeds sometimes, which is the
Mm.
Roth conversion. It's something selfishly that I'm really interested in learning more about as I start to go from, the accumulation to even more of a growth phase of my investing career. So Ross is here. He's going to share a lot about that and about BV Capital and how they kind of approach things. So, Ross, I will hand it over to you. The last bit of housekeeping. We will have time for a Q&A. If you have questions, though, as they come up, feel free to either put up your virtual hand or to put it right into the chat. And if able, we'll kind of intersperse them throughout. If not, we will definitely at the end get into them. So please, we want to make this as interactive as possible. Certainly, this is time with someone like Ross that most of the time you're not able to get. So take advantage, ask all of your questions. I'll certainly be doing the same. So, Ross, thank you. I'll pass it over to you.
Great. Thank you, Jordan, very much. I'll go ahead and share my screen and let the visual effects come into play here. And I appreciate the opportunity. Thank you all for taking time this evening for allowing me to educate and hopefully entertain a little bit. Although my role is president of a capital markets group, but I'm judged on my sales and velocity of capital raising. I find that capital is trusted to people that know what they're doing. And if I like to educate my investors and potential investors into feeling very, very comfortable before they fork over $1, $100,000, $200,000, whatever it is. So I'm all about education. That this is all about tonight. So I'm happy to answer any questions at the end, as Jordan alluded to, and hopefully at least give you some things to talk about with your family, with your CPA, with your financial advisor, or whoever, as a result of this conversation. But this strategy is unique because obviously it's designed to potentially reduce the tax cost of converting a traditional IRA into a Roth IRA. Now, I know everyone is probably very, very well aware that converting a traditional IRA to a Roth IRA is not new. It's very much allowed, has been for almost 30 years. But how can I lower my taxable basis in that traditional IRA before I convert and create that taxable event? Well, that's why I'm here tonight. And hopefully over the next 30 plus minutes, maybe 40, we can get you some good rationale as to how that's possible, how it works, and why that might be a good fit or an idea for you and your tax planning and estate planning needs going forward. So here's kind of my major thoughts on our agenda tonight, just in the power of four kind of broad things. Number one, let's make sure we're on the same page and let's talk about the differences between a traditional IRA and a Roth IRA and make sure we understand the pros and cons of them. I think also the rationale and why investors consider using the Roth IRA and converting assets over there. I think it's a pretty strong and clean argument. Number three is how real estate development projects work and create a unique tax planning opportunity in that conversion process. And then finally, the steps involved into creating or executing on a discounting Roth strategy. So those are kind of the main things that we'll jump into. But let's start with just the basics, right? What is a traditional IRA versus a Roth IRA? What are the key quick facts and differences? Well, obviously, individual retirement accounts were made to be powerful tax advantage vehicles, but they operate very, very differently. Traditional IRA was all we had until 1997. So this was a very small chart back then. But since then, it's doubled because the Roth IRA has some compelling arguments as to why you'd rather do that. Traditional IRAs, well, they allow investors to defer taxes, obviously, on their contributions today, but the withdrawals in retirement are taxable. So the money goes in pre-tax, it grows tax deferred. When it comes out, Uncle Sam takes their bite, right? It's all taxable. In fact, they make you start taking money out through that RMD, the required minimum distribution, when you turn age 73. used to be 70 and a half. They've given us a little bit more time as Americans are living longer. I just saw the other day that the average life expectancy has gone up from 76 to 79. So that's where that 3 year gap has come into play. They've given us more 3 years before they start taxing us on our IRA money. But the annual contribution limits to these IRAs are very small. You can only put in $7,500. If you're over 50 like me, you can put in $8,600. And the income phase outs, where you can actually deduct those contributions, begin at just 81 grand for a traditional IRA. That's if you're covered by a workplace 401k, like if your hospital offers you a 401k plan, you can't even put money in tax deferred at 81 grand. If you work for yourself or if you work for an employer that doesn't offer a retirement plan, phase outs begin at 129 grand. And after 149 grand, all the money is non-tax, is non-deductible. So there's just not a lot of incentive to do traditional IRA contributions. It's not a realistic option for this audience, right? Or for other high net worth investors. So then people would rather do the Roth anyway. Well, why? Well, Roth IRAs require taxes to be paid up front. So the money that goes in is all after tax dollars. And contribution limits are the same, only $7,500 a year or $8,600 if you're as old as me. And it's all considered non-deductible, right? So it's all after tax dollars, non-deductible. It goes in after tax, but the money grows in that Roth IRA is also tax-free. So the money grows without any taxation. You can trade it all you want. All gains are tax sheltered. And when you take the money out someday, as long as the money's been in there for over 5 years or you reach age 59 and a half, you can take the money out tax-free. So all the money goes in after tax. The money is treated as all after tax because it's not taxable at all. So the Roth IRA is a much more coveted type of strategy because all the money that comes out is tax exempt. So why isn't everybody using a Roth IRA? Well, if you're single and you make $168,000 a year, you can't put money in a Roth IRA. If you're married or married filing jointly, head of house, I'm sorry, head of married filing jointly, it's $252,000. So 252 grand, you're ineligible to participate. So again, for this audience, you're probably making too much money to even contribute to a Roth IRA. So that's the problem, right? Is how can I get money into my Roth IRA? This was invented in 1997, but for high income earners, it remains kind of an elusive tool for annual contributions, but it is eligible for conversions. And that's how a lot of high net worth individuals have gotten money to the Roth IRA is by converting it from a traditional IRA. Historically, most investors have accumulated large investment balances inside their traditional IRA. Not because they contributed a whole lot, because when I first started, you could only put $2,000 in a traditional IRA. That was the maximum annual contribution. 7,500 seems like a lot to me because that's a big number from where it started. But as we leave jobs, right, and move around the country and move around employers, we have these huge 401k balances we accumulate. We take that money out and roll it over maybe into another employer 401k or maybe into these rollover IRAs. So over time, as we get older, hopefully we've put a lot of money in our 401ks, and now that money's been migrated and rolled over into these huge traditional rollover IRAs. And again, while traditional IRAs can be very beneficial for tax deferral, they also lead to significant taxable income in retirement when those distributions become required. So it's for this reason, some investors consider exploring converting portions of that traditional IRA now into their Roth IRA today and get that assets moved in the Roth IRA for that future tax-free growth and future tax-free distribution. So some investors, though, they're a little concerned or not concerned about those large traditional IRA balances, thinking that in retirement, well, you know what? I'll be in a lower tax bracket. I'll have sold my practice. I'm not making much money in every year now. I'm just living off Social Security. So my tax rate should be pretty low, should be. And therefore, I can just take out of my traditional IRA as I deem fit. So I don't really need that Roth. Yeah, it's great. It sounds great. I'd love to have one, but I'm just not thinking I'm going to have to pay much tax in retirement. Well, yeah, I've always said hope is not a strategy. Yeah, I'd love tax rates to be frozen forever. That would be great. Can anybody promise you that besides a politician? No. So I don't know. The future is uncertain. My crystal ball is as good as yours, but I wouldn't bet that tax rates in the future are going to stay the same or go down. Why take the risk of them going up when you can act today and lock in money into a Roth that you know will be tax exempt when you take the money out someday? So you have to figure out the decision for yourself, right? It's a very personal decision, but pros and cons to both, right? And maybe you're right about low taxation in the future, but maybe not. So the biggest barrier, really, I think, to Roth conversions is usually that tax bill. It really is. If an investor converts, let's just say $100,000 from a traditional to a Roth, that 100 grand is generally treated as taxable income, right? Key question becomes, is there a way to convert those assets, though, the $100,000 at a lower valuation? Because big reason thing is you can't undo what you have just done. If you convert money from a traditional to a Roth, you cannot unconvert or recharacterize it back as of 2018. Previously, you could for 20 years from 2000 and I'm sorry, from 1998 to 2018, you could recharacterize and move money back and forth from your traditional to your Roth and back to your traditional. And I'm sure the IRS got so sick of that, people were actually market timing their IRA accounts. They would take the gains from their traditional, move it into the Roth. If they lost money in the Roth, they move it back to traditional, claim tax credits back for the money they pay taxes on, and just kept playing this market timing game year after year after year. I'm sure the IRS had enough of that and said, no more. Once you move money to the Roth, it stays there. Whether it goes up or down or stays flat, doesn't matter. Your money is stuck in the Roth. Not a bad place to be stuck, but it reduces the hassle for the CPAs and the IRS if they're recharacterizing money back and forth. So it's an important decision now. You can't change your mind. Once it's in the Roth, it's got to stay there. So that is it. You're one and done when it comes to a conversion now. That is a new requirement. So I want you to think about your traditional IRA or your rollover IRA or where a large amount of your traditional money lies these days. What investments are inside there, right? Probably mutual funds, maybe some ETFs, maybe some individual stocks, maybe Bitcoin, maybe real estate. Hopefully all the above, right? Well, I'm sure y'all are big believers in diversification like me. But there's one investment strategy that offers an exclusive or like we said in the program, a hidden advantage, and that's ground up development. Ground up development projects offer you an opportunity to lower that valuation during the construction phase. It's like, what? How? Why? Well, it's because there's this temporary valuation shift in the project life cycle of that development project that creates a strategic window during that conversion planning process. So real estate development projects are very unique because they go through multiple phases. ETFs don't go through phases. Mutual funds don't go through phases, right? They just hold stocks, they hold securities, and that's all they do. But real estate development starts with ground, right? And then you've got a project on top that's hopefully producing revenue. So there's a multiple phases in a real estate development investment or project. So think about those phases. Number one, the initial investment period, right? The offering period, where we raise the equity necessary to get the loan from the bank to go out and build the property. That's the initial offering period, and that's where people place their money. And then when that project is done, you move to construction phase, right? You start going vertical on the ground and you build that multifamily complex, whatever it may be. And then once it's done, you get your certificate of occupancy, you begin lease up, phase three. Once the place is leased up, hopefully it's stabilized, and you're producing enough revenue, you can sell the property, dispose of it, make hopefully a lot of money on the project and the development, and then return capital to investors. Those are the main steps, the basic steps in a ground up development project. But it's during that critical phase two moment that hopefully takes the longest amount of time to building the place that allows for that discounted valuation. There's a lot of factors that go into the construction phase that kind of erode the value of your initial investment on paper. So while you might put in X dollars, you can discount those dollars based on the illiquidity of that investment, the development risks associated. I mean, development projects are probably one of the riskiest investments there are because, let's face it, a lot can go wrong, whether it's bad weather that cause delays, cost overruns, market shifts. If people start migrating out of that market area, the zip code that the project's going into, that could cause a longer life cycle for that property to stabilize. So there's a lot of development risk. That's why it takes I would say, it's supposed to be part of a diversified portfolio, not the portfolio, but a small part of a diversified portfolio because there are inherent risks in development projects. But you get to take advantage of those risks by discounting it in your valuation. So all those things go into a factor to create a short-term discount during phase two of the project. So I want to make it real clear that this is not an arbitrary discount. All right, this isn't Ross Curtis looking at the balance sheet of the project and start scratching off line items saying, yeah, we can discount that, we can discount that. This is not arbitrary. Nothing about this valuation process is arbitrary. Professional valuation firms specialize in this field. And multiple sponsors use multiple third-party inspectors and valuation services and their methodologies that are established and well practiced for many years to determine that investment's, I wouldn't call it fair market value, but fair book value that we turn into a fair market value and report it to the IRA custodians. And this documentation that we get is critical to the process for compliance purposes and reporting purposes because each IRA custodian, regardless of the investment strategy, especially if it's a private placement or illiquid investment, they require an annual valuation anyway. So it can be just telling them your book value hasn't changed, or it's me providing them a nice 30-page report showing this valuation has changed and it's gone down by X. And here's all the documentation that shows that and reflects that, and why you should reflect that on your system so our clients can do a Roth IRA conversion. So I deal with a lot of speculators out there, I would say, that really want to go with a fine-tooth comb over everything, which is great. We highly encourage due diligence at every step of this process, not just on the investment side, but also the Roth conversion side, because people want to understand. You know, they've never heard of this. I'm like, is this too good to be true? Is this really legal? Has it been challenged by the IRS? What's the precedent? How long has this been around? You know, all these good questions, right? Because we're all trying to assess the risk here. It's already a riskier type of investment anyway. Now we're starting to play with taxation. I want to make double sure this is all good. So our position is really this. This is a valuation-based outcome. Like I said, this is not a tax loophole. This is supported by standard IRA reporting rules around fair market values and documentation that we provide to the custodians and that we attest to. The principal of the firm signs off on it. The principal of the valuation firm signs off on it. And of course, the IRAs accept it and sign off on it. So there's multiple checks and balances that go into this process, just to give you all some clarity. Now, I have heard stories of individual investors making their own valuation report and sending it to their own third-party custodian and them accepting it. I would not recommend that in any way, shape, or form because if there was an audit there, there's no backup. It's just one person's opinion, and it's the investors. I don't know how valid that would be taken in a court of law. So I really would say go with a third-party valuation and a sponsor that does those, just to make sure that there's enough documentation in place as needed. We've historically used PCE valuations. They're based in Florida. They've been around since 1997. Ironically, the same year the Roth IRA come out. But many of the big sponsors in the real estate development space use PCE. That's how we got introduced to them. And we've used them now for 3 deals and are about to use them for our 4th deal. We've already signed our engagement letter with them. So we think they're great. They've done a good job on our valuations, and I'm happy to share. If any of you all want to explore this more after the call and you see value in this, I'm happy to share one of our reports with you. I paid good money for them. They're sitting in my file, so I'm happy to share our PDF if you want to look at this further after a setup call. That's absolutely fine. Happy to provide that. Again, all about disclosure. So, okay, we've talked a lot about this. Let's take a look at what it looks like in a graphical representation because I love graphs. Graphs are my favorite thing. I would only show graphs if I could, but compliance makes me show other things too, like words. So we call this the J curve. Kind of looks like a J on the side or maybe a fish hook, but it really is supposed to kind of show the life cycle of the investment on paper as it flows through those phases we saw earlier. So remember, the construction risks exist during that construction period. So once the initial investment is made and you start to break ground, well, that's when the investment is illiquid. That's when development costs are being incurred. You're paying for permitting. You're buying the labor. You're buying all the parts, the lumber, all the tools, and renting all the equipment. And over time, as that property is completed and leased up, right, the value should increase. Once you've got a property actually built, visitors can come in and park and walk in and look at the units they want to rent. All of a sudden, now you're creating value there, right? And as they move in and start paying rent, the value just keeps going up and up as it gets more full and more full with more tenants. So that is the kind of the life cycle of a project on paper, what it looks like from valuation standpoint. Simply put, we tax you, or the IRS taxes you at a lower book value, but when we sell the properties at a higher market value. So your goal is to capture that delta between the lowest possible book value amount during the construction phase, and then cashing in at the end when we sell the property and realizing all those gains inside your Roth IRA at the end when the property is sold, hopefully at full or near stabilization, right? That's the goal. That is what the strategy is trying to do. Of course, there's no guarantees, but that is the process in a nutshell. Well, let me go back one more. So let's look at the numbers on the side a little bit. So the goal for most multifamily development projects is to double your money. So in this example, we're starting off with an initial investment of $250,000, and you're investing in the sponsor's grant development project. And once we get that 30% devaluation report from our third-party provider, we mark it down to $175,000, report that number over to your IRA custodian. And if you convert that amount, now all of a sudden you've got $175,000 showing on your account statement and also on your 1099-R that you've taken that much money out of your IRA account, and that becomes your taxable basis instead of the $250,000 you put in. And then, of course, the money's converted to Roth, and all the money grows inside the Roth IRA. And hopefully, when we sell at the end and we've doubled the money at $500,000, all that money is inside the Roth IRA tax exempt. The example, of course, is purely illustrative. And the key takeaway here is that the taxable conversion amount is based on the fair market value at the time of the conversion, right? The time of the conversion, not necessarily the original investment amount. So it's a key example and the key reason why this strategy has become very, very popular. Our IRA business has grown dramatically since we started offering this on our first multifamily construction project back in 2023. So we've done, like I said, 3 of these total. Our 4th is in the works, and we've got 2 more coming up in 2026 and 27. So we've got a nice pipeline of future multifamily developments that we plan on utilizing this strategy for. I'll pause there for a second, Jordan. I'm sorry. Is there any questions you want me to talk about before we go on?
That's been fantastic and really interesting to learn about. Saeed had a good question, which kind of goes back to the beginning, but is it a good idea to start Roth conversions from a traditional pre-tax account, even if we're in the top tax brackets now and still working? And I think that kind of alludes back to what you were saying. You can never predict the future, but there's a chance that tax brackets
Yeah.
continue to increase or marginal tax rates increase in the future. So
Right.
your thoughts on that?
He must have read my mind because that's my next slide. That's perfect. Because I thought about that when I was putting this presentation together. I was like, you know what? That's a great graph, but let's look at a hypothetical real example of what it would look like at today's tax bracket. So let's say most of your doctors in a 35% tax bracket today. That might seem like a large, percentage to swallow for IRS, but let's take a look at what that really means over time. So today, if I were to take, let's say I'm going to build a multifamily complex in Buffalo, New York, right near Jordan's house, okay? And you want to invest in it. And I'm taking offers up to $250,000 per new investor. So you want in, I'm going to put $250,000, take it out of my traditional IRA or invest inside my traditional IRA, 250 grand. All right. Um, at 35% tax rate, if I convert that money to a Roth and not do the discounted valuation, but just move it over straight to my Roth, I pay $87,500 to Uncle Sam today at that tax rate. Now, if I hired a third-party valuation firm to do a valuation and they marked it down 32%, well, then my taxable amount would be $170,000 they take out of the traditional IRA, move it to the Roth, which would lower my overall tax burden to $59,500, meaning a $20,000 savings today. So $20,000 today is a decent amount, right? It's probably not going to make or break your year any one way or another. But think about the long-term ramifications of that one small difference in valuation pricing today. Where if I take that $20,000 that I save, that savings, and I have it inside my Roth IRA now, when that Buffalo, New York multifamily property sells someday, and I keep that money inside my Roth, let's say I put it in mutual funds or some various stocks, and just grows at a simple 8% per year over 10 years, 20 years, 30 years. Look how much that number grows. That $20,000 I save today, keeping inside the Roth, grows in 30 years to $280,000, right? Over a 10x just by that little tax savings I saved in the short term. So it's a great positive double whammy. I save lower tax base today on the conversion, and that money grows inside the Roth tax deferred for a long time. And if I don't live 30 years, well, then my heirs get that money in the Roth IRA tax free, and they can never have to take it out either. So it just keeps growing and growing inside that Roth for my beneficiaries or my wife or myself. So it's a powerful, powerful example of taking a short-term hit today. Yes, I'm paying tax, but if I pay less tax, that money really grows exponentially. So it's a huge, huge difference. Simply put, in my youth, when the Roth IRA came out, I was working at a mutual fund company in the retirement plan operations department, ironically, and they showed me all these examples, and I was really tax averse, probably still am. I did not convert any of my small traditional IRA dollar amounts that I had in my account into a Roth IRA. My girlfriend, now my wife, did. So, because I was very tax averse and she understood the long-term benefits, she's a little smarter than me. But I just really was really against paying Uncle Sam that extra tax money today. Even though I knew it would be worth more in the future, I just didn't do it. So my price of procrastination, by not converting that traditional IRA money and keeping it all inside that traditional IRA where it still sits today, could bring a bigger tax bill tomorrow. In fact, I know it will. So I've got a large traditional IRA balance. So if I went to that Buffalo, New York multifamily project I wanted to invest in, and I took $250,000 inside my traditional IRA rollover account and invested it into that multifamily deal, and it doubled and gave me $500,000 back. When I took that money out someday, because I'm turning 59 and a half here before you know it, if I took that money out to go do something with it, I got to pay tax on the entire dollar amount, not just the gains, right? All of it, because all that money has grown tax deferred. So Uncle Sam, if I'm fortunate to be in a 35% tax bracket in the future, is going to bite me for 175 grand. So my total net after-tax value of that risky investment that I made and doubled my money, I only have $325,000 left over. So that is the unfortunate power of the traditional IRA. Yes, it grows tax deferred. When I take the money out, Uncle Sam is all over me, right? So I risked $250,000 to double it, but really all I have left, really, when you think about it, is 75 grand because Uncle Sam took $175,000, which it came out of the profit. So that's the price I have for procrastination. Now, what if I was smart and moved that money into my Roth IRA and I had a big $250,000 investment to make inside my Roth, and I made that Buffalo, New York investment in that multifamily deal, and it doubled in value. And when it sold, I got $500,000 put back in my Roth IRA in cash. The net advantage is 175 grand that I never have to pay in tax. Me, my beneficiaries, my heirs, nobody. Government never gets to touch it. So again, that price of procrastination could have cost me $175,000 in this example. Now, I've smartened up. I've started to make some traditional IRA investments inside of our development deals where I can start converting money over in increments to where I can benefit from getting the money in the Roth and hopefully seeing it realized there while I'm still alive and can pass on to my heir as well. So a huge example of why an opportunity cost there by not getting money to a Roth and letting the power of compounding happen on that side of the fence versus on a traditional IRA side of the fence. Let's see. Next, choose when the taxable conversion occurs. All right. Strategic timing is everything. I've been in the investment business since 1993. I got my series securities licenses, and I've been doing this for 33 years. And one of my favorites, you get a lot of sayings, you get a lot of acronyms, but my favorite saying is timing is everything. That's always one of my favorites. But you know what? It's not the only thing. When it comes to these types of decisions, it's not just about timing. Yes, you would maybe do this in a year where you've got lower taxable income, so it doesn't hurt, bump you in a higher tax bracket necessarily. But that's one of the beautiful things about this. In a construction project timeline, right? These places aren't built overnight, right? Unless it's a small little restaurant on a corner, like a little McDonald's or something might be able to throw up in less than a year, or some Taco Bell. But if you're talking about a 300 unit, 400 unit multifamily project, it could take up to 2 years just to get the construction done, let alone the stabilization. So you have a lot of time, i.e., a lot of tax years, where you can move money over incrementally. I mean, that's the other real powerful part about this. When I talk to a lot of investors, they say, "Yeah, I've heard the conversion at a discount. It makes sense. It's still a large nut to swallow up front by taking a big chunk out because I want to make a sizable investment. But you have to convert it all in 1 year. You can. I don't know if I recommend it, but you can if you want to, if you just want to get it done and over with. But you can take money out incrementally. So myself, I put $100,000 into a self-directed traditional IRA account, purchased interest in our first multifamily development deal in New Braunfels, got a 32% devaluation on paper. So now my IRA shows it valued at $68,000. So what I did in 2024 was move $30,000 out of the IRA and put in the Roth IRA, paid tax last year on the 30,000. Didn't affect me. I hardly even felt it, which was great. I was hoping that'd be the case. It was. And then the other $38,000 I took out 2025. I'll be about to find out how much it hurts in here in 2026 when I pay my tax bill. But again, I broke it up. Now, the funny thing is, New Braunfels, that apartment complex, construction literally just finished, but it's still in stabilization phase. And that property is not going to get revalued until we sell it. So I still have another year, maybe two, before that property is leased up and then hopefully sold to where I could have maybe broken that. I could have broken that conversion over 3 tax years, maybe even 4 if I want to take a more of a risk. But I didn't have to do it all in 2. I could have done it probably in 3 based on where the timing fell. So that's the beautiful thing about these conversions is you can stretch them out over multiple tax years and spread the tax paying around, so to speak. So doing it all in 1 year, yes, it's an option, but not a requirement. Not a requirement. You want to find out when that valuation occurs, and if your IRA can get it done in 1 calendar year, and so the lower valuation is reflected for you to do your transaction, then you've got maybe 2 or 3 actual calendar years where you can take money out and move it over and spread the risk around. I didn't put this on the slide. You can read this at your leisure, of course, but I think from an estate planning perspective, you really want to consider how this can be gifted to your heirs. By paying those taxes now in the conversion out of the traditional IRA, you're putting it into the Roth, you're leaving a tax-free asset balance inside that Roth IRA, for your heirs and beneficiaries. And since heirs, must generally empty those inherited traditional IRAs within 10 years, traditional IRA could push them into a higher tax bracket. They have to take the money out. It's not really, might not be there for their retirement because they have to take the money out in 10 years. In a Roth IRA, they never have to touch it. There's no 10-year shot clock where they take distributions out and empty the account by the 10th year. It all just stays in there as long as they wanted to. They can leave some to their heirs. So your great grandkids could be impacted. So it really is a great estate planning tool that, from just a simple slide at the front from traditional versus Roth, it really is a powerful, powerful tool for estate planning and future planning for your heirs. So something to think about when talking with your CPA or tax advisor and trying to coordinate it. This is a right idea for you. Generationally speaking, it makes a lot of sense. That's for sure. Whereas in traditional IRA, yes, there's still a benefit, but it's a taxable one. All So I don't know if we need to recap this. We've kind of talked about it, but here are some key takeaways I'd like to look at. But there's 4 letters I have to mention. I didn't put on a slide because I want to make sure we talk about it because it affects all real estate development projects, all real estate projects in general that you might invest inside of an IRA, and it's called UBTI, and it stands for Unrelated Business Taxable Income. And the IRS created UBTI to impose more of a level playing field between the non-IRA investments and the IRA investments. Because while IRAs are considered tax advantaged accounts, tax advantaged vehicles or structures, they are not tax exempt vehicles or structures. They can be for certain investments, but they're not designed to be for all investments. So things like commercial real estate that has leverage in place on them, if all the money in those types of strategies, riskier strategies, were all tax deferred and all tax exempt, people would be opening up all kinds of businesses and doing all kinds of things inside the IRA. And that is not what the IRA was intended for. The IRA was intended for Americans like you and me to save money for retirement, to supplement their Social Security, not to open up businesses and create large sums of wealth without letting Uncle Sam take their fair share. So UBTI was put in place to prevent that, all right, to make sure the government gets paid on any transactions or investment programs like commercial real estate inside an IRA. So if debt is involved, so levering up to create huge bigger gains off your smaller equity amounts is one of those examples where UBTI comes into place. So what is unique about UBTI exposure, what causes it? Only the debt financed piece or portion of the income or gain from a real estate transaction is taxed. So while no one likes UBTI, the IRS created it again for that level playing field. And it's indicative, it takes place in Roth IRAs and traditional IRA. If it's an IRA, it's going to, UBTI is as a factor. The good news is the custodians are in charge of it. They're the ones monitoring for it. We report to them what UBTI exposure is. They'll take the money out of your account and pay for it. So it's kind of on autopilot in a way, but I want to make sure you're aware of it because not every sponsor is going to talk to you about UBTI. They're going to talk to you about how great their project is, how great their returns are expected to be, how great their IRR multiples, projections are. But you want to make sure you know about UBTI because they might not talk about it. They might expect you to read the whole PPM And when you get to page 250 in the back, maybe you'll see the UBTI section and maybe you won't. But I think it's really, really important, again, about education that you know about UBTI, know that it exists. So if you don't want any UBTI or we don't want any taxation on your gains at all, well, then you can't invest in commercial real estate that has debt on it because debt is the trigger. If you find a real estate project that's all cash, no leverage, clear. If debt is minimal and maybe amortizes quicker, that's another green flag, or you might not have any UBTI exposure. If it's a long-term passive rental income deal, that maybe it's a long-term buy and hold, we're just going to hold the asset for a long period of time, then there won't be any UBTI because you're not going to sell the property, right? You're going to hold it for a long time. So um, there's there's ways to minimize the risk, and there's ways to maximize it. So if you got a high leverage deal, inside the project's a high leverage, low equity type of investment that could trigger big UBTI when the project is sold, especially if it's built and sold quickly, which is great from a liquidity perspective. But if you have a huge gain and there's a lot of leverage on there, you're going to pay a larger portion of the IRS. Still, all the money's inside your Roth IRA. It's still going to grow tax deferred, but again, the IRS will take its bite. So again, just a short disclaimer and disclosure about UBTI. It does exist on commercial real estate deals with debt involved. Um, and I think lastly, I want to close on some Q&A, but my favorite part of preparing for this presentation over the last couple of weeks and writing out some notes and thinking about these slides. And I was kind of anxious to see how Jordan was going to write his weekly reports and blogs about how to promote this. And he wrote in there, I wrote this down, that, you know, what makes it useful is not just the idea, it's how the whole thing is executed. The underlying investment matters, timing matters, valuation matters, your custodian matters, your CPA's input matters, and your overall financial plan matters too. Right? This isn't just a great decision because it's a great tax savings plan. It's not a great decision because it's a great property in a well-coveted area that's growing. There's multiple inputs you want to weigh into this. This sounds like a great idea. Let's go do it. Right? This isn't a call to action. This is just the tip of the iceberg. Let's just get started about talking about this, thinking about this, think of all the ramifications that this has current on your current tax situation and your long-term tax situation and all the parties affected and who you work with on the development side and on the custodian side. All those things matter. So you really want to lay it all out and check all the boxes, make sure you're comfortable with the whole strategy and see how it calculates and pencils out. And if it's something that you want to pursue, obviously BV Capital is here to have those long conversations with you as long as you want and show you what we can do to help with that process for you with one of our projects that are going to be primarily based in Dallas or the Texas area, not in Buffalo. Sorry if your heart was set on Buffalo, but we are a Texas-based, Texas-focused developer. All of our projects have been in Texas except for one, where we finished construction on a great hospital out in Sacramento, California. But everything else has been in the Lone Star State because, well, as a developer, you kind of want to build in the path of growth. And we know there's a lot of people still moving to Texas, and we think it's a trend that's going to stick around for a while. And we're trying to find areas around the state where you see growth that's coming and a not enough supply of homes or living space that's available to where we can maximize and create a shorter hold period for our new development projects with our investors. So we've been around for 15 years now and have built over 30 properties, sold over 17 different exits, either land deals or other multifamily deals, and I've got a long way to go. We've got about 1,100 investors in our different BV Capital deals right now, and some are, of course, looking to full cycle this year or next year, depending on the current market cycle. It's been hard to find liquidity the last couple of years. Probably well aware of that, but we believe that the best is yet to come as the economy and the growth here in Texas continues to improve after the huge supply glut we've had of new apartments coming online the last couple of years. We're starting to see absorption really take off around here. And we think exiting some properties and returning capital is going to be in the car for 26 and hopefully 27 as well. So again, happy to go over our track record. Anything else, any of the questions you have in the queue, we can take at this time.
Awesome. Well, thank you, Ross, so much. That incredibly helpful information from, again, kind of the basics where we started off to then this more niche sort of opportunity that, is something, frankly, that was new to me and understanding. And I think you highlighted really importantly at the end, probably the key part, which is like most things, it's about the team that you have and working with people, number one, that know what they're doing and that you can trust and that have a track record, and that they're going to work with you step by step. This isn't just like you said, this isn't a one-time thing where you click a button and the investment's done and all of a sudden, but it can certainly be a part of your financial plan and investment plan that's going to tweak things and help you tax-wise, which is where physicians get hit the hardest. And you're right in that, we get hit hard right now, but there's also, depending on how we set up our investments, there's the potential to be hit very hard later on as well, especially if everything is in pre-tax accounts. Um, so we'll jump into questions. I have some as well, but we'll go. David has a great one, which is can 401k be used with this investment strategy? So Roth conversions within a 401k. I think David is referring to.
Hmm. Yeah, if depending on your 401k custodian, 401k provider, if they're willing to take third-party valuation and mark it down, absolutely. If it's a solo 401k, definitely. That's where we see a majority of these taking place. For non-IRA users, a lot of solo 401k users have used this strategy. And I also want to make sure that this is only for equity positions. Some sponsors offer debt and equity positions inside their capital stack for new development deals. The third-party valuation markdown or decrease in value is only applied to equity. It cannot be applied to debt. So you have to take that quote unquote equity risk to get this benefit. You can't do it inside a debt instrument, just so you know.
That makes sense. And then I guess that's the kind of leads into my first question, which is like, who is the avatar person that this is best for? Obviously high net worth, but in terms of like, is it a lot of times you're seeing people who they have had that rollover 401k that they've put in that IRA and they're looking to kind of maybe they also do a backdoor Roth typically and they're looking to kind of like
Mhm.
rid that traditional IRA so they don't get hit with a pro rata. Is it solo 401k users? Is it all of the above? Is it
Yeah.
yeah.
It's a bit of all the above. Yes, we a lot of it. A lot checks a lot of boxes for a lot of people based on their preferences. A lot of people see that long-term growth of that one slide. They're showing the $29,000 saved today equals $28,000 tomorrow, and they love that. They want to do it now, and they'll take that big tax hit now, and they'll spread it over multiple tax years. But I've also seen some high net worth investors that this is new to them, and they'll do it all right now. They can't wait to get it all into the Roth IRA, and they'll do a large amount, and they want to get it inside that Roth IRA and let it grow and hit there, turn that 250,000 to $500,000 hopefully, and then watch it grow from there. So yeah, I've seen both. I've seen, I wouldn't say barely accredited investors, but let's just say, $2 million net worth, $3 million versus $30 million. Do it. So it's really both sides of the spectrum have shown interest and executed on this. And whether they spread it over multiple years or do it all at once, is kind of up to their unique situation. But yeah, I've seen both ends of the spectrum for sure.
Awesome. A question from Saeed, kind of along a similar vein. Is it a good idea to start conversions to Roth from pre-tax account in our working years and in the highest tax bracket? Is it better to wait until later? Um, a little bit of that is kind of applying the crystal ball, but what's your thoughts?
Yeah, I guess it depends on the outcome. What if we're looking about today, what is best for me today? Well, I would say don't pay any tax today, right? If you're thinking about tomorrow, well, how much are we talking about? $100,000, $300,000? And what would that money look like inside a Roth IRA growing at 8%, let's say, in 10, 20, 30 years? So I think you have to run what I call the cost benefit analysis, right? Maybe you do some now, maybe you do spread out over 3 years, do a third, a third, and a third at a certain dollar amount, and just see where it takes you. And you run a hypothetical illustration for three, four, five, maybe six different scenarios, from doing none and letting it all stay inside the traditional IRA, like I did for 30 years, and see where that gets you, or do a lot now and see where that gets you in the Roth IRA in the next 10, 20, 30 years. So I think you'll find the magic number of what suits you by running those numbers. by doing no conversion today to a lot of conversion today and different amounts, maybe over a 2 or 3 year period using some of this strategy and kind of see where those numbers end up over 10, 20, 30 years inside a Roth IRA at an X% growth rate to see where it comes out. I think that makes a lot of sense. And you'll find out which of those line items makes more sense for what you can stomach today and tomorrow.
Yeah, and I think like a way that I often try to think about it as I'm still relatively early in my investing career, but because you think, okay, is if I do pre-tax, again, that's great, and maybe I'm in a lower tax bracket later. If I do, tax-free, then I pay the tax now, yeah, but I never do it again, no matter what. And it's never, you're never going to be sure that one strategy is better than another, but a way to kind of like diversify that risk, like we talked about with investing, is, you want to have some pre-tax, some tax-free. And so it's generally not an all or nothing where you're going like, okay, am I just keeping it all pre-tax? Am I going to convert it all to tax-free? You're hedging your bets in some way. So this is a great way that when you do that, you're also lowering your initial um, tax hit because I think it does make sense. You do want to diversify, the tax treatment that your dollars are going to have when you do reach retirement.
For sure.
Um,
For sure.
Robert has a question here. I've been told that my investments in private lending funds could be discounted about 30%. I have no control as a limited partner as I have no control as a limited partner. Do you believe this is true?
A lending fund.
I
So the
know,
underlying
without
collateral
knowing the
is
specifics.
loans. Um, I I've been told when it comes to construction deals, right? Equity is only a part that can be discounted, not the debt, not debt investments. So that applies to commercial real estate, new development projects. So for a lending fund, that's obviously a completely different asset class, completely different investment strategy and structure. So uh, because loans are valued and should be valued multiple times a year, especially private loans, I don't see any reason why you couldn't discount the valuation of those loans and convert at a lower amount, assuming your custodian works with the sponsor and the sponsor provides them the documentation they need. I think that's a completely valid strategy that allows itself to have this feature for sure. In fact, I would say private credit these days is getting quite the nod for not doing enough valuation of their mark to market of their loans. So I think that's tremendous if you've got a sponsor that's willing to revalue those loans and mark them down that much or any amount. Quite honestly, that shows me you've got a well-intended sponsor there, in my opinion, just off that one talking point.
Great. Sudan has a great question, great point here. What are your typical hold periods for a multifamily project?
Yeah.
Since self-directed IRA custodians have a charge of like $500 plus per year to hold the investment, which is also an associated cost.
Yeah, absolutely. That's a great point. Again, I'm tax averse and I'm fee averse. So when I opened up my self-directed IRA and had to pay the startup cost and move the money over and made the investment and paid the transaction fee, and I pay a quarterly fee as well. But then again, I look at the long-term projected benefit of having that money inside the Roth. That all goes into account. And and I think what you find, and I find this in a lot of our investors, is once they get started on this, they do it more. Maybe they're not doing more conversions, but they're using that self-directed IRA for more things. They're adding more lending funds, other private debt, other private credit, other private equity, other private real estate. They're starting to take advantage of that because it's a benefit you're paying for. You've got this account now. Why hold just one thing in it, right? To me, that's counterintuitive. Well, I'm paying a fee to do one transaction. I got to sit and wait for 3, 4, 5 years. So I'm a big believer in maximizing my value. If I'm going to pay a fee for something, I'm gonna get my money's worth out of it. So, maybe add a few $50,000 positions here and there to diversify and spread out your nest egg a little bit more away from mutual funds and ETFs or stocks, whatever. But I see that a lot where people get started with an equity trust or a directed trust, and they get one fund going, and they add a second and a third and a fourth and a fifth, and they're getting a diversified pool of illiquid products inside that IRA, and they're getting their money's worth. But and that being said, I think that's smart because of each strategy has its own life cycle. multifamily investment versus an industrial investment versus a self-storage versus a lending fund versus a private credit debt fund. There might be an evergreen fund and never sell out until you decide to redeem your shares or your units. So typically, brand new ground up development project should go at the very least, if you're lucky, 3 years minimum. If you can get it built, you're permit ready when you raise the equity, and it's not a huge 500 unit project. Maybe it's 250, 300, sizable but not too big. And then of course there's demand. Get it stabilized, and if it's a doing well and getting market rents, you can sell it and get out in 3 years. That's the best case scenario. Very rare can you do it less than three. So I would say three is the minimum amount. Everyone likes to talk about three, but it's rarely accomplished because everything's got to go like right, which like never happens in development. So I like to say five, give it five, and if I do it in four, you'll love me. If I promise you three and do it in four, you hate me. So three is to me is a stupid number because maybe, but not realistic. I say five, you should be able to do it in five. Should be. Now, market environments, interest rate, zip code changes, change in government, change in tax laws, all kind of things can happen to stretch that five out. But if you can do it in less than five, I think you're doing great consistently. And if you can do it, in three, you're awesome. You're doing everything right, obviously, all the time. But three is not sustainable. We've full turned four multifamily projects that we've built, and it was all in three. They averaged all 3 years. Now, I want to go back to the market environment we did that in, though, between 2015 and 2019, when interest rates were cheap, institutional demand was everywhere. If it was a stabilized, good cash flowing product, there was buyer interest regardless. So yes, we've done it in 3 years a lot, but it was in a good market environment where that was, I would say, the norm. Not great, but average. It may be a little bit above average, but because we built good property in good locations. But I would say 3 years is definitely should not be touted as realistic in today's world because interest rates have gone up and they've stayed up, and institutional demand has gotten a little tighter. And I would say it's been a lot of new supply, which creates more competition. Which why should I buy your brand new unit over the one across the street that maybe is only a year or two older? So there's a lot more competition out there for your property. So I would say adjust. I just say 5 years is kind of your minimum expectation. And if it can beat that, great. And if not, be ready to go five regardless. And I'm sure there's some factors out there that are causing a delay. Hopefully not the sponsor level.
Yeah, I think and that right there is like pretty to me refreshing honesty because a lot of, you know, places you won't hear that hey, we did it in three and that was fantastic, but it was a great market, and so things lined up for us to do that, and it may not always be like that, or even currently the environment we're in is not as conducive to that. So no, I,
Right.
I appreciate that. And then a quick follow-up question in our last minutes here from Sudan. Could you name the SDIRA custodian you're referring to that charges per account rather than
Oh,
per asset?
oh, they're all a little different. They're all similar but different in their own pricing structure. Um, I use equity trust, but I only have one investment inside equity trust,
Hmm.
so I haven't really taken the leap of faith to add a second one yet. And I'm not sure if they charge me by the unit, or I should say by the holding,
By the
or just by
investment.
the account.
Okay.
Um, I believe they will charge a new setup fee, but I don't think they charge you more because you've got more money in there. It's just a flat account, per account. Um, so account because we probably send a lot of business to certain custodians and they give us and our clients a better price annually as well as per deposit.
Awesome. Well, this was definitely incredibly informational. Ross,
Good.
before we sign off, could you again just give everyone a quick best way to get in touch with you or learn more? And then we'll certainly include that on our follow-up, which will
Oh,
include the recording.
oh yeah, absolutely. Of course. My email address is Ross Curtis at Ross.Curtis at bvcapitaltx.com, TX for Texas. I know I had it on the screen earlier, but I jumped off so you could look at me and Jordan again. But a little camera hungry. But and our toll free number is 800-484-0073, and just ask for me. There's seven of us here in the BV Capital headquarters for Capital Markets Group, and we're here 5 days a week, except for tomorrow. It's Good Friday, but we'll be here and happy to help anytime. I also would say look me up on LinkedIn, Ross Curtis, BB Capital, easy to find. I meet a lot of investors or prospective investors, and current clients are LinkedIn with me there too. Jordan and I are LinkedIn on. You're LinkedIn with Jordan, you can find me that way too. You can look through his contacts, but yeah, hit me up anywhere, LinkedIn or our homepage is bvcapitaltx.com. If you just funny thing, if you just Google Roth conversions at a discount, BV Capital comes up very quickly. So we've done a great job of tagging a lot of our articles on our website, and Google picks them up, and you can find us that way too. I bet you if you just Google this topic, you'll find BV Capital and you'll find me. So lots of ways to connect, and happy to do so in whatever medium is best for you.
Awesome. Well, thank you, Ross, so much. Thank you, everyone who's joining live, who's watching the recording. We appreciate it, and we'll see you soon.
Thanks, Jordan. Appreciate y'all.
Bye.